Welcome to Digital Currents, brought to you by Morgan Creek Digital. I'm Xavier Segura. Each episode, we spotlight the topics and people changing the tech industry with a focus on AI, blockchain, chips, and big data. Thanks for listening, and please make sure to subscribe if you like what you hear. And remember, stay current.
All right. Hello. Let's adjust. Doing it solo today, so different angle, different view. But welcome everybody to Digital Currents. X is on the road in the Middle East, so I'm just going to hang out and chat. Give you a quick update. We'll do the sock reveal. Wearing the red pants today. You know, when there's blood in the streets, Lord Rothschild said, actually, I'll come back to that. So I have the Satoshi Genesis block sock game on today. So going back to the beginning, you know, we have I think a banking crisis going on under the scenes or behind the scenes, which is, you know, leading to some other things we'll talk about. But so back to Lord Rothschild. So the red pants, you know, normally it's Bitcoin Friday, I wear the orange, but, you know, Lord Rothschild said, you know, buy when there's blood in the streets, even when the blood is your own. So there's a lot of blood in the streets. There's a lot of stuff that has gone down a lot since we were together a week ago. I mean, just looking at, you know, Bitcoin, which we'll talk about right away, you know, Bitcoin now it's not down a lot. I mean, it's down 5% in the past week, but that's little misleading because it went up nicely, about 5-6%, and then fell back 5-6%, you know, so about a 10% drop off the previous peak. And if we look back to, you know, October 6th, quote unquote, what may be the cycle high, if crypto winter really is here, which I probably think it is, then we're down, you know, good $30,000 on the price. So about 25%. That's a meaningful drawdown, and not the end of the world, but a meaningful drawdown. But that pales in comparison to some of the downdrafts in the traditional markets. Things like quantum computing or nuclear, some of the AI nonsense. And there's a lot of good AI stuff, but there was some just crazy AI valuations, data center plays that didn't have any data centers built yet or were promising big data centers, and there was all the circular stuff, but we'll talk more. So on Bitcoin, you know, I talked in January, did my 10 surprises, and I talked about the fact that, you know, I was probably in the minority that thought the 4-year cycle still existed and that we weren't just going to go up only and to the moon. And by the way, GM to those who practice, you know, my Bitcoin cup from my good buddy up in New York at Fashion Week. But I think what's interesting is did the 10 surprises. And I said, look, I think the 4-year cycle is intact. I think it's hard coded into the way Bitcoin operates in terms of how the miners secure the network. If you cut the number of block rewards, then prices need to rise in a cycle to make sure half of them don't go out of business. But inevitably, price increases attract different layers of investors and traders and speculators and ultimately gamblers. And so you get this typical cycle. Remember, when there's fair value, and we've talked about this on and on lots, and Tim Peterson has, I think, the best model on this at N squared value that calculates the Metcalfe's law value of the Bitcoin blockchain network, right? Networks have value. We can determine what they are. And his number's right around 91, 92K. And so when the price is below that number And, that fair value was probably closer to 75K when we hit the lows of 15K a little over a year ago. And I mean, think about that. A little over a year ago, maybe 18, 19 months ago, we were, or 15, 16 months ago, we were at 15,000, and people thought, literally some people thought we were going to zero. But we were a good 80% below fair value. And then the investors, people like us and others, start to buy. And that starts to push the price closer to fair value. As the price starts moving, traders enter a market, and they don't really care what the value is. They just want movement so they can go long or they can go short. As the price hits fair value. So, and this happened right around the halving. And so we hit fair value, and you go past fair value. Well, now if it costs somebody X to produce an asset and they can sell it for more than X, right? They're not in the business of hoarding that asset. So it could be anything. It could be an oil producer, could be a wheat producer, could be a corn producer, could be a Bitcoin producer. It could actually be, anything where you're generating something at a value and then you sell it in the market, right? So you become a hedger because you're selling your product, and then a speculator doesn't really have a view. They're taking the other side of a trade. Because remember, for every buy, there's a sell. The speculators come in, and that pushes the price potentially even more if you attract increasing numbers of speculators. So what normally should happen is that supply increase, people selling, should push the price down, but it incents more people to be able to buy. And so you get a continuation of the rally. Well, as the rally continues, then you get into the final stage, which is where the gamblers come. And these are the people that come in and they lever up and they spoil the party for everybody in the sense that they push prices to extremes where everybody, the short sellers try to short it and they get run over, and you get these parabolic blow off speculative tops. So if you go back to 2017, fair value was 10. We went from 10 in November all the way to 20 in December. From November 6th to December 18th, went up 100%. Crazy. People thought it was going to go to the moon, but you're looking at it going, well, now we're 100% above fair value. And then something happens. In that case, they introduced futures at the CME. Leo Melamed said he wanted to tame Bitcoin. Not a good word. And boom, we fell. And not only did we fall, but we fell all the way to fair value at 10 by April. Then we blew right through that through November the following year, all the way down to 6. But then the problem, and I was talking to Tim about this last week, I think we talked about it on the show, is then we went from 6 to 3, like overnight. And that's the final flush of the levered speculators and the gamblers, levered gamblers and the speculators. And, the miners aren't going to sell at that price because they're losing money. So you get in this just depths of the bear market. People are unhappy. Things are ugly. And then the investors come back. And so the cycle starts all over again. So by 21, we got all the way back to, fair value of 33,000. We went to 69, and then boom, we have the collapse again on the day that the CME introduced a bunch of new futures. By the way, I'm wearing the navy blue on top. Notre Dame big game this weekend. Got to beat Pitt. At Pitt, actually friendly. I mean, I won't say we're friends, but I know the coach at Pitt's brother reasonably well. He was my best friend's best friend when they lived in Mexico together. Great artist, Bradley Narduzzi. But so I never root against Coach Narduzzi, but I am rooting against the Panthers. So go Irish. The investors come back so we got to the cycle in 21, and we went from 69 all the way down to 15. So at 15, right, you're well below fair value. I said fair value had probably gotten up to, maybe it wasn't 75, but it was probably up to 65, 70. I can't remember exactly. But we were well below fair value, and the investors start to buy again. And now fair value is 91. We got all the way to 126. And here we are in fourth quarter. Now, I wasn't certain on the date of the peak. Logically, the cycle is 3 years and 11 months, not 4 years. It's 3 years and 11 months because of the way the number of blocks is based on block height. So the number of blocks determines the cycle. We got there on October 6th. It's interesting. There was a guy in 2023 who tweeted that October 6th would be the day. Wow, that was pretty good. Okay, but he just did the number of days. And in the previous cycles, it was precisely 1,064 days to the peak, and then 364 days to the trough. So unfortunately, we got a ways to go to get to the trough and the end of crypto winter. But all that said, that doesn't mean it's going to crash tomorrow, and it doesn't mean we're probably not going to go down as far this time as we have in previous cycles, because it's just gravity, right? If you're 2 times above fair value, that downward pressure is greater. This time, if we were, say, 25% above fair value, or maybe 30% above fair value, could we go 30% below, 25% below? Sure. So, are we looking in the 60s, maybe 70 as I don't know. So, and I'm again not saying it's going to happen tomorrow, but I do think that's as likely as, look, the other side argues that no, there's this excess demand, new demand, the ETFs and sovereign nations, and that's true, but the way markets work, right? There's never excess supply or excess demand. There's always a buyer and a seller. So the whales, and I've been wearing the whale sock game, last few months a lot, that it's the whales now, these accounts that have been inactive since they bought the Bitcoin at $10 or $100 or $1,000. And so they made a lot of money, and people are mad because they're selling. Like, well, but that's kind of natural. I mean, at some point, we need those coins to come into circulation. If we want billions of people to use Bitcoin, we need more coins to be in circulation rather than just hodled and stored in cold storage. And people say, "Oh, no, we could just divide into Satoshis." Yeah, we can, but ultimately, is it fair or right or actually logical that people who were there early, who paid pennies on the dollar to get this asset, now people have to pay hundreds of thousands of dollars of fiat to get the same asset? Is that really logical? Probably not. But the point is, I think it's highly logical that people who have those assets are eventually going to sell some for running money, right? The money you put aside, because we still live in a fiat world. They're going to put some, they might diversify into some other things. Maybe they want to own some other asset. Maybe they now, maybe they're like the Winklevoss twins who own lots and lots of Bitcoin, who just set up this Zcash DAT. We'll talk about DATs here in a second, digital asset treasury companies. So, which have been taking it on the chin. And Michael Saylor was on television this morning refuting the rumor that MicroStrategy had been forced to sell Bitcoin to pay the bills. He said, we're actually buying a lot, his words. We'll see. He said at the Bitcoin meeting earlier this year that someone asked the question, so what happens if, and now when, the short sellers push your stock below 1 MNAV, so below the value of the Bitcoin that you hold in the balance sheet? He says, I'll just issue debt and buy back my stock and increase the Bitcoin per share. And so we'll see if that's what he's doing or if he's doing something else. But my guess is he probably is doing that. I know at Metaplanet, where a board member and can't comment too much, but I can say that the plan that's been publicly announced is that starting in January, they're going to issue prefs, form of debt financing in a world where interest rates are very, very low, and entice people to save in a Bitcoin-backed debt instrument. I think that will create a lot of demand for that product and end up giving Metaplanet lots of money to buy more Bitcoin to increase the Bitcoin per share. So long term, I think it's a great story. I think we got to get between now and then to the point where right now people believe that digital asset treasury companies are assets minus fees, and that there's no flywheel effect, there's no benefit. They're never going to go back to a premium above MNAV where they can hit the ATM and issue new stock. I think people are wrong. Market cycle. We go through euphoria, we go through fear, and fear is the great wealth destroyer. Right? There's the fear of not engaging or not buying. That's lost people more wealth than pretty much anything else, in the sense that you're always afraid that the market's going to crash, or you're afraid that technology is not going to work, or you're afraid that idea is too big, or you're afraid that you might need the money for something in the short term. Having a discipline to have some money that you're always investing, particularly starting early. Some advice to my younger self that I wish someone would have told me, that the best investing advice is just to start early and often. It doesn't matter how much, a little bit compounding the eighth wonder of the world. Really, really important. But doing it and fear of doing it, I think, costs people so much. Like when I got my first 401k, there was no one in our firm who counseled us. We had a very nice HR lady, but she was not an investment person. And she's like, "Oh, we have these GICs." What's a GIC? A guaranteed investment contract. Oh, that sounds good. Guarantee sounds good, right? Well, it was a 3% guarantee in a 4 or 5% inflation / currency devaluation world. So basically my money lost value for a decade because I was an idiot. I didn't start as an investment person. I started as an insurance guy, and like 40% of other people in the world, which is a crazy stat that 40% of people spend some time working in the insurance industry. It's a big industry. And all other industries depend on it. But ultimately, fear of engaging, I think, costs people the most. The second most costly thing is panic. And that's what's kind of going on now. We got a lot of panic selling. Now, in some cases, that selling is good. Like people who FOMO'd in to things they didn't understand, like quantum stocks, right? Quantum stocks, they had this parabolic move because people who actually understand math and investing were shorting them, because these were basically pump and dumps. I mean, literally pump and dumps. They had very little stuff. They had ideas, and, maybe they'll develop something over many, many years. But in the current, had no, not very much other than ideas. They had no revenue in some cases, or just a little bit of DARPA money. And so if you have no revenue, to have a multi-billion-dollar market cap makes no sense, unless you're like a biotech company where you wait for an FDA approval of a drug that you actually have. But to bet on the anyway. So these things went crazy up, and short sellers, Martin Shkreli and others, were trying to short them, Jim Chanos, and they're getting run over. And that's the way it happens until it doesn't. And now they're just getting pummeled, like down 5, 10, 15% every day. And I think they can go down a lot from here. But if you avoided it, better. But panic selling an asset where you have a high conviction in something, for example, Bitcoin, makes no sense at all. What you want to do is you want to own a piece of the most valuable computing network the world has ever seen. You definitely need to do that. And so I'm not saying you should put everything in. You maybe, and if you're young, you may put a decent amount, but it is the base layer of the future of money. It is, I think, the best savings technology that's ever been invented. It is digital scarcity, whereas gold is analog scarcity. Digital is better than analog. So, long story is, today is one of those days. And again, but Mark, you just said we're going down more. Yeah, we probably are. So I'm not saying buy it all today. Kind of take your time. Just keep accumulating. Right now, we're in what's called a distribution pattern or distributive market. And that's where the, big money, the old money, is distributing to the masses. And so in the quantum world, it's bad. Like it's literally pump and dump. Or there's this one guy, I think it's D-Wave. Like the CEO literally has sold all of his shares as of yesterday or as of 2 days ago. I mean, that actually should kind of be illegal. I mean, it's free will and free markets. It shouldn't be illegal, but holy moly, if you're out telling people that you have this great company and yet you're selling all your stock, or this Oklo thing, this, mythological micro nuclear reactor that they got rejected in their application to even start. So they don't have any technology. The couple, it's a husband and wife team. That never works. Not because husband and wife can't work together. It's just history shows us that those are usually pump and dumps. You can point to a lot of them. Neither one of them actually has done very much in nuclear. And yet here stocks going up and they just keep selling. So they're getting rich and everyone else is getting poor. So I wouldn't be dollar cost averaging into those, but something where you have strong conviction. I'm sorry. Distributive markets. So I got distracted. Distributive markets are where, the assets are being distributed to a broader base. It tends to happen at tops. I would say insiders don't sell at bottoms. Again, hedgers. When you're an insider, when you create something new, you create a new company and you have stock and you created it, you're going to eventually sell it. So you need a speculator to take the other side. You're a hedger, right? You created this asset, you're going to sell it. But insiders don't sell at bottoms. Like if you thought your stock was undervalued, you wouldn't sell it. It's kind of like when I worked at the university and people would give gifts of appreciated assets. And we should have started a hedge fund. Every single gift that we ever got, that was the peak. Like maybe not the day, but every single one, they went down. In fact, in one case, very famous guy who owned the San Francisco 49ers gave a big amount to build a building. His stock went down 80% and there wasn't enough to build the building. And they kind of went back to him and said, you need to give us a little more. He's like, I'm out. So they had another guy come in and help fund. He was a big famous TV guy from New York. And it worked out, but people don't donate things that they think are undervalued. They donate them that they think are fully valued. Same thing here. Insiders don't sell when they think things are undervalued. Now you say, well, what about the Bitcoin insiders? Well, they're not insiders. The people that bought Bitcoin early didn't create it. Now there are some, like Jameson Lopp and others, the developers who were there early and own a big stake. If they were suddenly liquidating, that would have information content for me. But if it's someone who just, they bought some drugs on Silk Road and they didn't sell the Bitcoin, that person's not an insider. They were early, they're an OG, so to speak, but they're not an insider. So I think what's happening in the market right now is distributive, and therefore I wouldn't be in a rush to accumulate my entire stake here. And look, I could be totally wrong, in the sense that the overwhelming new demand that I think is there, right? Sovereigns are buying it. We just saw the Czech Republic put it in their treasury after Ms. Lagarde said this will never happen in Europe. We will only let them buy CBDCs. Sorry. And by the way, if you're not terrified, I mean, literally terrified of CBDCs and all the talk of digital, IDs and you should. And I posted the clip from Mr. Robot, which if you haven't watched Mr. Robot, it's amazing. I mean, it's tough. It's a hard show to watch. It's very violent. It's very dark, but man, the writing is unbelievable. And the acting, I mean, Remy is just dazzling. But the guy who plays the head of Evil Corp does such a good job. So resist all of that, because look, in a world where you have to ask permission to use your money, which is the world we live in now, the banking system, it can work okay because there's kind of a lag. There's an analog lag. If I go to the bank and I show up and I say, this is what I want to transfer my money for, they kind of have to do it. In a digital central bank, digital currency world, they can just program it in that, let's say, I get my paycheck today, it's Friday, and I have a cocktail tonight and I am pissed off about the administration. So let's say, hypothetically, I drunk texted about the president. In a CBDC world, they could turn my money off. That's a dystopian nightmare that I don't want. And so unbank yourself, so to speak, buy Bitcoin, use it as your savings technology. We still have to live in a fiat world for now. But we got to resist the CBDCs. Those are Evil Corp. But we're in, I think, a distributive pattern, and it's being exaggerated by, I think, again, I'm not like saying it's going to be 1929. So on that point though, so I do think it's a little interesting that, Andrew Ross Sorkin is on this book tour for his book, 1929, that he spent 8 years writing. And it's like my Genesis block socks. Bitcoin wasn't created in like the 2 weeks leading up to January 2009. Right? It's not an accident that it was released right in the heart of the global financial crisis. It's just not. And so it might not be an accident that Andrew Ross Sorkin is doing this book tour about the history of, the Great Crash in maybe the greatest bubble market we've ever seen. Not maybe, it is. Like on every valuation metric, it's the worst bubble market we've ever had. And again, I'm not saying it's predictive programming per se, but it's certainly possible. And look, maybe it gets worse, but I think it has to do with leverage. There's too much leverage in the system of all kinds. We're starting to see the cracks. And look, I lived through this. Now, fortunately for us, I was at the University of North Carolina at the time, and we had done the work from when I got there in 98 through 2000 to load the boat load the portfolio with hedged, with a capital D, strategies. Julian was kind of our anchor. And then we had a whole bunch of other hedged funds, long, short equity funds. And we had put about 30% in that. And in 1980, 1998 and 1999, there was serious pushback. And into 2000, in first quarter 2000, and it's interesting because this ties into a big story this week on Michael Burry. So Michael Burry this week released a letter saying he was shutting down his hedge fund and that he's giving back everybody's money because the markets no longer made sense to him, and that his idea of determining value was, just antiquated, I guess. And he was catching a lot of grief because he bought $9.2 million worth of deep out of the money puts on Palantir stock. And, up until a couple of days ago, Palantir was going straight up and along with everything else, and people were making fun of him. And so he released this letter and said, okay, I'm out. And it was eerily reminiscent of a letter that Julian Robertson sent out on March 20th, 2000, that basically said the same thing. Basically said, and I tweeted this, and you can see the two letters side by side. Michael's is very short. Julian's was more eloquent. Julian was he was the best. He was the perfect Southern gentleman, man of the highest integrity I've maybe ever met. One of the brightest minds ever, greatest identifier and trainer talent the world's ever seen in investing. Just beautiful man. And he wrote this great letter and basically said, I don't get it. I'm giving you back your money. And there were a few of us who had the privilege to stay in, kind of side by side with him. And in 2000, 2001, and 2002, Julian crushed it. I mean, he was ridiculed in 99 and 2000. We crushed it. I mean, we're up 57% in 2000. I mean, the market was down like 11 or 12. I mean, it's crazy. So, but long story short is in February that year, we had our usual board meeting in Chapel Hill. And I put up the GMO chart that said, going forward, the next 10 years, U.S. equities would lose 1.9%. And emerging markets would do well, and REITs would do well. And my board chair said, Mark, you are not allowed to say the letters G, M, or O in a sentence ever again. That guy is always wrong. It's impossible for the market to be down for 10 years. It was. And he was wrong. It wasn't minus 1.9. It was minus 3.4, compounded per year for a decade. And so when valuations get to levels that are extreme, it doesn't mean they can't get more extreme before they go down. And that's usually the way it happens, right? Is we're early. The Big Short, Michael Burry. We invested not with Burry, but with 5 other people in the Big Short trade, short subprime. But we started in early 2007. And there's that scene in the movie where they're talking about, oh, we got these guys. And, it's going our way. And it was, the Goldman guys. And so our first month with John Paulson's fund, we were down like 35% in a month. And my clients were like, you're an idiot. And we kind of felt like idiots. But we were early, which is often the euphemism for wrong. But we had great conviction in this trade, and so we kept increasing. So I think the same thing is possible here. I think the mania around ChatGPT. I mean, ChatGPT it's a great tool, but it's a tool. It's not a paradigm shift. It's not a platform. It's a tool. And I said this the other day, is AI is not going to replace humans in lots of things, but humans using AI are going to replace people that don't. And there are a lot of people who think that certain jobs could go away completely. It's probably true, but that's been true of every technical innovation in history. And yet we have more jobs today than any time in human history. Just think about that. Every technological innovation, whether it's a steam engine or the railroad or air travel, whatever it was, it destroyed jobs. But it created more jobs. The internet got rid of some types of jobs, but it created more jobs. So we'll figure it out. Human creativity, I think, is the most powerful force in the world. But I think there's some companies that got to levels of valuation that are stupid. I mean, that's a word. And I think there's a lot of that could come out. Do I think it's 1929? I don't, except for some of the similarities related to debt. So First Brands, this aggregator that, took old brands and put them together and issued a bunch of debt. Turns out it's a little Ponzi schemey, and they were pledging assets multiple times. The debt went to zero. Now, when debt goes to zero, equity is worthless. Think about that. Remember, because equity is a residual claim. So if the primary contractual claim can't get paid, then there's nothing left for everybody else. So we're starting to see cracks in the facade that there's a lot of debt related to a lot of these businesses. And the worst part is, just like in 2000, 2001. So back to the UNC story, we put a lot of money in hedge funds. We put a lot of money in, hedged strategies, short, the big debt strategies, short equity. And we loaded up on distressed kind of right afterwards, because what happened in 2001 was all the stuff that people said they were doing, WorldCom, Enron, Time Warner, they weren't doing, right? There was this whole kind of behind the scenes, kind of hidden SPVs and hidden debt. We kind of got that again. Google's doing it and Meta's doing it. And, we're finding stuff that people told us. And the problem with 100% of US GDP being AI infrastructure spend kind of feels exactly like the dark fiber build out. And a lot of that fiber just never got lit up. And I remember people talking about square inch real estate being the most valuable asset in the world, the fiber optic cables. No, it was valuable and it certainly helped, but it was really the software and the innovation around companies like Akamai and others that helped us accelerate the internet and broadband connectivity. And so brute forcing AI by using more inefficient chips that were actually not designed to do thinking. GPUs were designed for a certain thing, and they're very good at it, but they weren't necessarily designed for what we're trying to force them to do. And using more of them, it's great for the company selling them. But DeepSeek is a great example where they're like, well, I can't get the good chips, so I'll just write software that does some sampling that's better. And there's a new one that just came out, Kimi, which is okay. I mean, it's fast and it's cheap, but I don't like the way it, I don't know. I don't like its voice, I guess. And maybe it's because I'm not young, and maybe it's speaking in a more hip voice. But I do like the way DeepSeek processes information and gives real useful information. The thing I hate about ChatGPT, by the way, always agrees with you. It tells you how smart you are for asking a question. I don't need that. Just do your job. Because there's a subtle manipulation in that. Like if you tell someone, oh, that's a very good question, then they feel good about themselves and maybe they're not as discerning and maybe they're not gonna ask the really hard questions. So I don't need to be manipulated, but actually I'm being manipulated all the time, right? So in that crash from 2000 to 2022, 2000 to 2002, I remember 2000 was not the crash. 2000, I think, say we're down 11 or 12. And then 2001, we were down more, like 14-ish. But it was 2002 when all the debt stuff really started to unwind, where we were down the most. And then, in March of 2003, we had to have the president come on and say, I think this is the time to buy stocks because we're going to bail everything out with this new thing called QE, which was invented after 1929 in 1933. So again, not saying we're in 1929, not saying that it's going to unravel completely, but I do worry there are similar excesses and we could have, some additional downside before things get better. So all that said, what do? Well, you follow your plan, right? Fear which is what gets created, and panic, which is what gets created in these times, will destroy your wealth, right? If you're selling the assets that you have conviction in because you're afraid, that's equally bad to not buying them because you're afraid. So there's the two sides of that coin. And the innovation is going to continue, right? I mean, the amount of innovation that's happening right now across the ABCDs, which we talk about on the show, AI, blockchain, chips, data, is extraordinary. We were just talking with this, you've heard me talk about him. I call him the kid. He's not really a kid. He's a young adult, but he's young, but he's super smart. And, he went to that, University of New Jersey at Durham down the road, and he invented this methodology for merging photonics and silicon connectivity and processing power, and is a way to use photons instead of electrons to process information. But this is going to be big. Now, is it going to be as revolutionary as the original silicon chip, inventions in AMD and Intel way back in the 60s, when they came out of Fairchild? If you're really interested in this, you should read the book about the history of Silicon Valley, but you should also go back and just read the wiki page on Fairchild and this magnificent group of guys, and they are all guys, and they have the white short sleeve shirts and the black ties, and they just look just right out of central casting. But man, they were so impactful, and they were mad geniuses, and they led to the development of Silicon Valley and venture capital and all the things that I believe in today in terms of backing innovation as an asset class. And that innovation is going to continue. In fact, I think it's going to accelerate because we have all three, right? We have less money chasing deals. There's still a lot of money, but it's less than it was in the peak in 22. We have the technological advance of the 2024, TruthNet. And then we have all the disruption, all the people that are being laid off at the big companies that have to start something. And that's real. And the last time that happened was 1996. And that was a really, really good vintage year. We've had 2 out of 3 or 1 out of 3 many times since then, but we haven't had all 3 out of 3 for a while. So pretty excited about this vintage. And it's interesting. History says when it's the hardest to raise money, future returns are the best. And when it's easiest to raise money, future returns are the worst. It was really easy to raise money in 21. It just was. Right now, it's the hardest I've ever seen. Like full stop. Now, not for Andreessen and not for Kleiner and Sequoia, but for us guys, it's the hardest I've ever seen. And gives me pretty good hope. It's the inverse. Like I feel good about that, which is good. It's the inverse of how I say you should invest, right? I say if your portfolio doesn't make your stomach churn a little bit, it won't make your grandkids smile a lot. And, ha ha ha. But it's true, right? I say all the time, if you make an investment and you feel good about it, you probably lose money. If you feel really, really, really good about it, you're going to lose a lot of money. If you make an investment and you feel a little sick to your stomach, probably do pretty well. If you feel really uncomfortable, like it's just really gut-wrenching, you're probably going to do really, really well. Because if you feel great about it, it's already in the price. It's the masses, right? Buying Rigetti at $100, everybody else, everyone else is doing it. I might as well do it. Bringing it all back to where we started. Is Bitcoin cheap enough? Could it go cheaper? Yeah. ETH at 3,100. There are people who are saying it's going to 10,000 by the end of the year. No, it's not. There are people who say it's going to 55,000 next year. No, it's not. Is Ethereum the world computer, smart contracts? Yeah, probably, maybe. Solana competing with that? Sure. But it's got a lot of work to do. The Zcash thing recently is pretty interesting. Monero too. I mean, privacy is back. Look, privacy is a fundamental right. Secrecy not so much, but privacy is a fundamental right. And the way blockchains work, making everything public, including all your history, like if I put my MetaMask wallet up, people can see everything I own. That's a little different. So we need things like Railgun to kind of sheathe some of that. But here's the problem. If you write the wrong kind of software that some government doesn't like, they put you in jail. Now, that's never happened before, but they just sentenced the guy who wrote code. That's a frightening thing. Again, that doesn't terrify you. You're not paying attention. So look, lots of stuff to talk about. Time to be cautious, but cautiously optimistic in the sense that the innovation is going to continue. The opportunity sets are very robust. Got to stick to the plan. Got to be disciplined, and keep, let's say luck. It's where preparation meets opportunity. So it's time to get lucky in the sense that, everyone who's a Bitcoiner, other people say, oh, you just got lucky. Well, it's times like this when, no, I worked really hard. I gained conviction. I did the work. And there was going viral last week. What's the biggest mistake you've made in investing? And there were lots of different things. And not surprisingly, a bunch of them were, I blew off Bitcoin in 2015 because I wasn't willing to do the work. I was skeptical. And lots of things. I mean, I could list a dozen like really bad mistakes. Probably the worst in terms of my wealth was, because it was the earliest, which means the compounding would have been, I was working at this value investment shop. And, because I worked there, of course, I was smart because I worked for an investment firm. And, I got this rollover money from my 401k from my old company, the insurance company, to the first investment firm I went to work for. And instead of just buying what I thought I should buy, which was, Intel and Microsoft and all the things with this computing thing that was just starting back in 1991. The internet had just been invented. I thought I was smart because this broker was in the office talking about these two really cheap stocks. First of all, the broker is hawking what he has to sell, which I didn't understand at the time. So shouldn't have listened to a broker ever. And long story, one of the stocks literally went to zero and the other one basically went nowhere. And the portfolio of companies I was going to buy went up a lot. So that was a big mistake. So that overconfidence because of your situation, do the work. So, but the other one was, look, in 2013, Dan Morehead gave me the gift of a lifetime and said, hey, you should do this. And I'm doing it. And Pete Berger's doing it. Pretty smart guy. And I just didn't listen. So that was a mistake. I mean, I backed his venture fund, which is great. It's done great, but I should have done the Bitcoin fund, but I didn't. But the bigger mistake was about 9 months later, I did get it. I did see it, but I wrote about it. I used to write these long letters and I wrote about it. And the feedback was bad. Like people calling me literally saying, we'll fire you. And the mistake was I listened because they hadn't done any work. They were reacting emotionally to something they didn't understand or appreciate. And I didn't follow my own advice. And look, nobody's crying for me. I've done fine. And I'm a big believer in Bitcoin but that was a mistake. And you're going to hear it now, right? If you've got a plan, if you've got a conviction, people are going to say it's not working. I'll tell you Bitcoin's bad. Peter Schiff's out there saying, oh, it'll never be $100,000 again. Okay, Pete, short it. Anytime you want, I'll give you the borrow. Challenge, Peter, if you're listening, probably not listening. But you want to short it, I'll give you the borrow. So all that said, thank you for listening. Rate, review, and subscribe. I don't do it as well as X, but rate, review, and subscribe. And, remind everybody to stay current. And that just means be engaged. Be engaged. And we'll be back next week together, the dynamic duo. And enjoy your weekend and talk to you soon.
Thank you for joining us this week on Digital Currents. Check out our links to our website and social media in the show's description box. Please make sure to subscribe if you like what you hear. And remember, stay current.
This podcast should not be construed as investment advice nor solicitation for the sale of any security, advisory, or other service. Investment themes and ideas discussed may be owned by funds managed by the host and podcast guests. Any conflicts at the time of production have been mentioned by the host but are subject to change. Listeners should consult their personal financial advisors before making any investment decisions.